Hello, everybody, and welcome to the third quarter Klaas Financial webinar. Thank you for joining us today. My name is Josh Stirling, and I'll be one of your presenters today. Today, you can expect about a 25-minute presentation, and afterwards, we'll have about 10 minutes for a question and answer session. Throughout the presentation, if you have any questions that you'd like answered, please go ahead and put those into the Q&A box at the bottom of your screen. We'll be happy to answer those at the end of the presentation. Quick overview for what we're going to cover today. We'll talk, of course, quite a bit about the economy and what the Fed's been doing and some of the implications towards that. We'll talk a bit about inflation as well. And then we'll talk a little bit about the end, your bond portfolios and how some of those factors might have impacted it. So we'll go ahead and jump back here to our slides. So for those who might not know, Klaas Financial, we have two offices here in the Midwest. We have one in Rockford, Illinois, and one in Madison, Wisconsin. But that's not as far as we reach. We actually reach all across North America. We service clients across 32 different states, and we help people prepare for and succeed throughout their retirement. Today, joining me is going to be Eric Schwartz and Todd Eklund. And jumping right into the topic today, Todd, I am really interested to hear on how you're going to compare today's economy to road construction.
Well, thank you, Josh. Thank you for joining us this afternoon, everyone. We appreciate it. If we go back a quarter, it kind of seems like an eternity has passed since the last quarterly webinar. And at that time, we didn't know what was going to be happening with the economy. And what we were worried about, what the big question on everybody's mind was at that time was, are we going to dip into a recession? And we actually didn't have the data before that webinar came out. And what happened since then is that you had 2 quarters of a slowdown. It reversed course a little bit because the data actually just came out today and we had a pretty good quarter. So what I would characterize what's been happening in the economy is it's like road work construction. We're having a slowdown. It hasn't been a disaster, but you have the Fed doing the construction work, what it takes to cool things down, and it's just a detour rather than you being stuck in a ditch. So
it'll be compared to like 2008. That was kind of like an earthquake in California, breaking up the roads.
Exactly. I mean, there's a good example. It is not experiencing a earthquake that is just ripping the roads apart completely, right? And that's indicative with the GDP data that came out today that showed the economy expanded by over 2% in the most recent quarter past. So we'll see it. Are we out of the woods yet? Probably tough to tell. And one of the things we're going to talk about here is there's a difference between the economy and financial markets, that's for sure. But some good news, and hopefully we'll all be at 60 miles an hour here by mid-year next year. But anyway, at any rate, this is taking a look at just graphically what I was talking about a moment ago, and what you're looking at here on the screen is the year-over-year percent change in GDP growth. So you can see that blue line dipped down negative for the past 2 quarters, but you can see also that it was not nearly as severe as going back to, say, 2008 or the really deep but brief recession during COVID, which is indicated by the gray bars on the screen. So we'll call it the Federal Reserve speed bump, right? They're deliberately trying to slow things down. That is what they do when the economy is running too hot. They raise rates to cool it down, and vice versa when you're in a recession or a deep recession. So it's a good speed bump in some sense.
Yeah. So Todd, like you mentioned earlier, the economy is different from investments, and I feel like we all can see the pain in the market. So what's kind of the background to that?
Yeah. So it's important to note, as Josh said, the economy is not the same as the financial markets, and so you could say, well, especially with today's pretty rosy numbers with the economy, that we're having a pretty decent year, in terms of just what the economy is doing, right? And you have strength in employment and consumers, but this is one of the worst years we've ever had for just investing and the financial markets. And what we're looking at here on the screen right now is what this does is it takes all the asset classes of mutual funds tracked by Morningstar and looks at the percentage that lost money in a given year. And so this is a little bit counterintuitive because where you see very low bars or nothing for instance, like 2019, that's essentially a perfect year where everything made money, right, that you can invest in. But the orange bars indicate that almost nothing made money. And so you can see that we're in one of the worst years in history in terms of just no financial assets generally across all investable assets have gained for folks.
Yeah.
I would also note that 2018, it seems like, oh, that wasn't that long ago, but the difference between this year and 2018 is that in 2018, you didn't have bonds drop in double digits. And so that's really the pain of this year, is having both stocks and bonds decline by double digit numbers, which is really, really rare, something we haven't seen in quite some time.
And even when it does happen, it's those very rare instances where it doesn't happen again for like another 20 plus years. The last time we saw it was unusually in 2008. But
it's infrequent. And so we'll see what, again, you've probably heard us say this before, and we don't mean to sit on the fence about things. We try not to make too bold of predictions, because year to year, it really is hard to tell what's going to happen. But this is a pretty unique year in terms of how painful it's been from an investing standpoint. On the brighter side, though, it looks like things really aren't that bad in the economy. So who knows what that could bode for next year? Certainly having 2 years in a row like this would be hard to imagine.
Yeah, and I think you make a really good point about the economy versus the financial markets, because we look at this morning, I mean, we wake up and we see that GDP, grew 2.6, the economy grew 2.6%. And the market was rather mixed today. Some people might expect, we got good economic news, the market's going to go gangbusters, but it was a rather muted, mixed response today. So really important to keep those two, difference between those two in mind.
Well, Eric, one of the primary reasons why we're here, and one of the things that continues to persist, is inflation. But what's continuing to push that?
Yeah, I feel a little bit like a broken record. I feel like at least the last 2 quarters we've talked about this topic, but it just continues to be kind of one of the headwinds that we're facing. The first, we got a couple pictures here that we're looking at. The first one is really alluding to the supply chain issues that we're facing right now. Shifting demand coming out of COVID, COVID shutdowns that are continuing in Asia, and I think the other obvious one is the ongoing war in Ukraine. These are all kind of conspiring together to keep inflation rather high. I mean, if you look at if we focus on the war here for a second, you look at I think a pretty obvious one would be oil, right? So during normal times, the world gets 10% of its oil from Russia. At this point in time, there's been a concerted effort not to buy Russian oil. And in addition to that, there's, when there's a war in a country, generally cargo ships and planes can't go through that territory for whatever reason. So it just continues to really mess with the supply chain that's already struggling to get back on track post-COVID. And I have a dangerous title here, Relief on the Horizon. You can see we have a question mark there at the end, right? I think we can all agree it probably doesn't feel like we've seen a lot of relief, or we felt a lot of relief just in the normal everyday things that we buy. But what we've seen here in recent months is inflation at least begin to level off or maybe even plateau. And it seems to be coupled with, again, this data can be dangerous, but it seems to be coupled with the point at which the Federal Reserve began raising interest rates. And again, that could be a coincidence, but it also could be the Fed's policy having some impact. So Josh, what are your thoughts kind of on this timeline?
Yeah, so I think that the best way to kind of look at this is what has the Federal Reserve done this for, and what are they trying to get out of it? And the biggest thing that they're trying to do with hiking interest rates is use one of their biggest tools in their toolbox. And I've heard this metaphor before, it's the Fed's sledgehammer that they can use to kind of help correct where the economy's going and influence what might happen. And that's with interest rate hikes and reducing interest rates. And they've had to use it aggressively this year. And the primary thing that they're trying to do by raising interest rates, in the media, you'll hear a lot about the economy's running really hot. We need to make sure that we pull back a little bit. The Fed's going to raise rates, and we heard a little bit about this before COVID, with maybe inflation rising a little bit. But the primary thing that this actually does is it disincentivizes people and companies from spending money with loans, credit cards, debt. And by doing that, it can help to solve one of the issues that you have in the supply chain issue, which is demand. Demand has been very consistent throughout the past 2 years, even through a COVID spike. It's continued to go through. And so that can help to increase inflation. And so by disincentivizing businesses and people from going out, buying a big new home, buying a luxury vehicle, doing new projects for your business that is going to produce great growth with your company, by making those inflation rate hikes happen, people are now going to second guess what they're going to be doing. And you might have businesses putting off those plans or raising more cash or waiting until interest rates fall back down. And so this might be what we're seeing here, is kind of people second guessing, not spending as much, and businesses deciding to hold off until they see where they're at when loans are being reissued and refinanced along the way. Well, Todd, I feel like a lot of this is because the Fed has increased interest rates really aggressively. But can you tell us historically, how is this compared to the past?
Good question, Josh. So this notion of the Federal Reserve hiking interest rates and cooling the engine down, so to speak, is not a new concept. You can see here on the screen, there's been lots of different Fed rate hiking cycles, lots of slowdowns, recessions in the economy, things of that nature. But what makes this one unique is how rapid it's been. And so what you can see here with the lines on the screen is that no cycle has moved this far upwards this quickly ever, and it's pretty unique in that regard. So we'll see where it goes from here. I think when Josh mentioned a moment ago with the economy and where we're at today, that the number that came out that was pretty positive and optimistic. If inflation is still high, they still could be at this for a while. And again, that means not trying to be too bold with a crystal ball, but you could have a growing economy and the Federal Reserve still staying, with their foot on the gas with interest rates, and that could be sluggish for financial markets, right? The economy is fine, we're growing, but you could have pretty disappointing stock and bond market compared to what people are used to getting in their year-to-year returns, possibly.
Mm-hmm. I think another interesting aspect on this graph here is that the fact that interest rates on this most recent interest rate hiking experience started near zero. Most of these other situations started at 3%, 4%, and kind of went up from there. This has been a drastic shift from where we have been over the last 10 to 15 years.
That's a great point. The starting level was so low to begin with.
Yeah. So moving ahead here to the decision makers that have come into making these shifts over time, looking at the prior 15 plus years that we've had with the Federal Reserve making their influence to either keep rates low or shift them higher to impact the economy. We've surprisingly at times had 3 different individuals giving similar policies, similar beliefs. Ed Bernanke, Janet Yellen, and Jerome Powell all at times had interest rates very low, at historical low averages, very close to 0% or at least under 2%. And even as the economy's been doing well and inflation has been able to maintain under 2% for a long period of time. But recently, Jerome Powell came in and back in 2018, 2019, he started raising interest rates, but then when COVID hit, dropped them right back down to zero. And then earlier this year in March, started to ramp it right back up again when inflation was kind of getting out of control. But Todd, what are your thoughts on some of the prior the Fed heads?
My comments would be this: that each of them brought had their own unique era to deal with, and they also had their own unique expectations and background in terms of where they came from and shaping how they thought about policy. So Ben Bernanke and Janet Yellen were both academics, right? By way of background, it generally shaped a given way that they think about the world. They both tended to be, other things equal, easier monetary policy, meaning they liked to use monetary policy and low rates generally as a tool. Ben Bernanke had the crisis to deal with, right? And so when he used some extreme measures, Janet Yellen, things were pretty good and sanguine. Now, Jerome Powell is really the interesting off the beaten path Federal Reserve chair in a sense, because if you think about it, he's lived on both sides of the extreme with interest rate policy. He went to the floor with them and went very extreme on the easy side of things during the COVID crisis to help get us out from that. And now with what we're experiencing today has gone the opposite direction. Interestingly, his background is one, he comes from the private sector, and I think he's a lawyer by training, not an economist. But he certainly stands out from the crowd in terms of living on both sides of the teeter-totter compared to recent Federal Reserve chairs.
Mm-hmm.
Yeah, I think it's no matter what area you're in or who you are, it's a tough job because you have to make the decision right now to purposely slow down the economy. And I think politicians, regular everyday people, nobody wants to at some point in time see us purposely slow down the economy, but to get inflation under control just seems like the only way to go at this point.
Well, it's also worth noting, as you kind of alluded to, the Federal Reserve chair is supposed to be politically agnostic, and I would contend that generally over time, at least in my opinion, it usually is, pretty free from political influence, which is a good thing. And I think that continues to be the case today.
Mm-hmm. Well, let's move ahead here onto how this has directly impacted part of your portfolio. Historically, we talk quite a bit about the stock market equity and what that's been looking like, especially as the stock market is the one that's typically the most volatile, and it jumps up and jumps down, and we want to put our attention to that. But we want to take a little bit of time here to talk about another part of your portfolio, the bond part of it, and the direct impact that some of these Federal Reserve decisions have had on it. Because, like I said, it doesn't typically act like stocks, but it's kind of felt like that this year. Bonds don't typically have double-digit negative returns, but a really high rising interest rate environment like this has been a primary component of that loss. So moving into this, we want to talk through a hypothetical example of a bond portfolio. So like I said before, everybody has parts of their portfolio in bonds, and that's always been the stable part of it. But when 93% of your assets or investable assets across the board have gone down this year at a significant level, it's concerning. So what we have up on the screen here is a hypothetical $100,000 bond portfolio. And it shows that bond portfolio's growth over a 10-year period of time. So each year you see the blue bar go up and up and up. And you'll notice for this kind of feels like what it did over the last 10 plus years. Slow, steady growth. And that's because those bond portfolios are giving you tiny bits amount of income every month, every year, and those then get reinvested into the portfolio. However, that's not what that looks like this year. This year, the portfolio got walloped. And so we want to talk through here on this next slide, not about necessarily how interest rates being risen and affecting the portfolio hit it really hard, but we also want to talk through how it can recover from here on out. So let's concentrate on this next slide here. The very first year. So we're generating a hypothetical reaction to the significant rising rate environment. At the worst point this year, a generic bond portfolio was down at a max of about 17, 18%. So this one is showing a little bit further than that, but it's still very helpful, very valid. And in a significant interest rate hiking environment, you have this immediate pricing reaction in the bond market. And we've felt that this year. It's felt pretty painful. But what ends up happening on the backside of it is that you're getting higher interest rates. New bonds are going to move into the bond portfolio. They're going to start paying more. And the key to how you can recover is by, one, having higher interest rates, but number two is time. And so we can see here that when you're getting more income from your bond portfolio, like we had back in the 80s and 90s, you can make up that loss with enough time. Right here, we're looking at about a 5 to 6 year break-even point, where you're receiving more income than you would have been at that lower interest rate environment. And that's not to say that as long as you have 5 years, you're going to be golden. Things can change. But also on the other side of that, people might be saying, well, I don't have 5 years. I'm taking money from my portfolio now. And the situations that we run into with financial planning is that people have a lot of time. Typically when people retire, like let's say you're retiring in 2 years, you're not going to be going to retirement and then pulling out all your money from investments. Retirement's a long period of time. And even those who are already in retirement, say you're 73, 74, you're taking RMDs out of your portfolio. Even with all that being considered, pulling money out of your portfolio still has about a 5 year break-even point with higher interest rates. And that's because those higher interest rates are going to pay out to you in cash. And those payments coming to you are then going to help you make those distributions. You're not going to have to sell as much bonds or stocks. So in the end, it can be more beneficial, but unfortunately, it does take a bit of time. This year was painful, and it's like we talked about many times before, it's very unusual to have both stocks and bonds go down and be this significant. But going forward, bonds aren't going to shift as drastically as stocks in terms of recovery, because the stock market trades on expectations and kind of moves a little bit more volatile. But the bond market will eventually recover and will hopefully be receiving quite a bit higher interest rate payments.
Yeah, I think the really important piece there is we've had a lot of stability in the bond market in recent years, but the amount of income or interest that those bonds have produced has been really minuscule. And as you mentioned, as rates come up, it's really painful right now, and we recognize that. We understand it's tough to watch your portfolio. You know, the space I think a lot of us think of as the safer space in your portfolio take a hit, but this is why we felt it was really important just to give you an idea of what is happening under the hood and where we might be able to go from here.
I know that we were looking at some of our portfolios earlier this week, Todd, and one of our short-term bond portfolios that we have, I mean, 6 months ago was paying what, 1.5%. Now it's almost at 4%.
Yeah, it's doubled essentially. I mean, it's the benefit, particularly in a short-term bond portfolio, you recoup it quickly.
Mm-hmm.
Yeah. All right, so that was a pretty deep dive. We recognize that as well. We generally try not to get too technical on these webinars, but like I said, we felt like it was important to give you all an idea of why you're experiencing the volatility you've seen this year. I want to kind of pull us out of the weeds here a little bit and kind of back to the big picture. And I know we say this every quarter, but I think now more than ever, we're getting a lot of mixed messages from the economy and a lot of just general volatility in the markets. This brings us back and I think helps recommit us to our principles and to our strategy. You know, our firm's belief is that as you go through turbulent times, you stay the course, and you understanding that it's difficult at times and uncomfortable. We believe the best advice in most cases is to stay the course. And I know, we're talking to a cross section of folks today. Some of you may be saving for retirement. Some of you are in retirement, collecting income off these portfolios. So I want to really drive home that in general, we're speaking to both groups. This is not the idea, and Josh just mentioned it, that, well, as long as you have time to wait and not take any money out, you'll be fine. That's not what we're saying. I think no matter where you are, as the market gets volatile and as we begin to go through these less profitable times in the investing world, it's really important to stay the course. And for folks who are taking income from their portfolio in retirement, just keep in mind you're not selling the whole portfolio on one day, right? We're breaking off chunks over time, collecting income to supplement your lifestyle. So we were coming off a period where the market was up really high and you were breaking off pieces of your portfolio at really high valuations. Where we sit now, obviously, it's come back to reality, and we're breaking off pieces at lower valuations. But we build your financial plans based on the long-term averages, and that's why when times get volatile, the one thing that we can't plan for is cutting and running, essentially pulling things from the portfolio. That's where your financial plan can actually be impacted in the long run.
And I think that's well said. Well, that is the end of our slides here. Let's go ahead and jump into a bit of Q&A. So we don't have many questions here, so hopefully we can have a few more people.
Don't be shy, ladies and gentlemen.
But let's go ahead and take a look at this first question here. So is there a chance that the Fed could overdo rate hikes?
You want me to start?
Yeah.
Sure, absolutely. And I think what we said earlier, so we had the economy bounce back with today's GDP number that came out. I think it was 2.6. Is that right, Josh?
Yeah.
So that's a pretty strong number. We were talking about before this that, on the low side of things, you could have had, the economy is growing again, and it was a 0.5% or something, meager, but it bounced back pretty strong. What will be interesting is that if it still stays a pretty strong economy, but high inflation, they'll have to stay potentially, well, I shouldn't say have to, but could likely stay on the gas pedal, what they're doing, raising interest rates. And so if your definition of overdoing it means raising interest rates and getting inflation to slow down, but that also means poor stock returns, then yes, there's a strong chance they could overdo it in that context.
Yeah, I think the hard part is that the impact of raising interest rates, which, like Josh said, is the Fed's biggest or most impactful tool, is that it can sometimes often take a while to see the impact of those rate hikes. So for the Fed, they're a very data-driven organization. They're not necessarily working with the most recent data because it takes some time for it to come full circle, I guess you could say.
Mm-hmm. All right. The next question that we have, Democrats are getting hammered on inflation. And I'll change this question just a little bit, but what are potential solutions for solving inflation that politicians can impact?
Ooh,
it's a really good question.
Where do I start? So many ways. How do I not offend anyone? This is the truth. There's so many things the government spends money on that contribute to inflation, that contribute to the national deficit. And depending on where you sit and where your perspectives are and how you solve some of those things, I've heard, I went to a seminar years back when debt was so out of hand. I think it was like 2010.
Yeah.
And people talked about it. One of the biggest things is, cutting military benefits, which is just unthinkable, right? I think every party has their sacred cows that are hard for them to, cut down.
Yeah.
So, where do I begin? But let me.
I think the difficult part is a lot of what may be the most effective at pulling inflation down is going to be spending cuts, to what Todd just said. And that is about the least popular thing a politician could do in times of, number one, the stock market experiencing tons of volatility, a huge sell-off, and just talk of a recession coming and maybe a tightening labor market. But I don't know that I have a really good response to that, because I think a lot of what we're seeing is driven by just a high demand for fewer products. And I guess the one thing that potentially you could look at is intervening more to try and fix the supply chain. I don't have good examples of what that looks like. But to me, that would be one of the biggest things that would have the largest impact on inflation.
Mm-hmm. Yeah, I think probably one of the most simple answers is that nobody really has the answer. Inflation is caused by a lot of different things, and there's no one easy solution for it. So it comes from lots of different places. It comes from companies. It comes from government spending. It comes from supply chain issues. The list is endless, and being able to come in and finesse your way to a solution is really difficult to have any one person or one party to be able to have the solution. I mean, if you think about a potential solution for solving the supply chain issue, I think there was a piece that came out about chip shortages and bringing them back onshore. That's government spending, which can also cause inflation. So there's a bit of back and forth with it, and there's no perfect solution. It's going to take time. And I think one of our biggest benefits that we have is we have an independent Federal Reserve that can come in and step in when needed. Having that independent party is powerful. And we're kind of seeing some work now. We'll wait for more information to come out. But I don't think that should be taken lightly that we have such an independent and strong Federal Reserve that they can go out and do what they think is right.
Yeah, I don't think it's surprising that the organization doing perhaps having the biggest impact on inflation right now is an unelected one, so to speak, because you do have to make unpopular decisions, right? I mean, I think people looking for houses right now and seeing mortgage rates, at 7% instead of 3%, are probably not liking the rate hikes we're seeing from the Federal Reserve. So there's tough decisions that need to be made, and I think for an elected official, those are often difficult to make.
Mm-hmm. I think I saw some data today about existing home sales going on. I think it was a 9-month streak of declining existing home sales, which is just the speed of how fast homes are being sold in the market, the volume. That's not to say that it's just people going out and buying, but people maybe reconsidering selling their home because they don't want to refinance it when they get a new home, get a new mortgage at really high interest rates when you lock something in for 2%, 2.5%. Just a few years ago.
Yeah, that's we often hear from clients, and I'm sure it will surprise no one. Specifically, when the housing market was so high, people would come in and say, "I need to sell my house right now. It's so valuable. The problem is there's nowhere for me to move because then you have to buy something else that's expensive." So it's certainly. I'm going to bring us back to the question. I know this wasn't a really satisfying answer, I'm sure, but. I don't think there's a great answer to that. It's tough.
Well, we don't have any more questions right now, but please feel free to bring them in. But Eric, I think we had an interesting question during a meeting yesterday, especially with some of the headlines that I've seen recently with it. I-bonds. I-bonds are paying over 9% right now.
Yes.
Right? Yeah.
Yeah.
Do you think it's worthwhile for people to go out and get an I-bond if they're sitting on excess cash that maybe they don't need for their emergency reserve?
Absolutely. Yeah. I think we talked about this a few quarters ago when inflation first started to rise, and it was suddenly people were remembering that I-bonds exist, I guess you could say. But I mean, one of the, I guess, silver linings of inflation, if you can call it that, is that I-bonds are paying over 9% now. And I mean, there's a limit, $10,000 a year that you can actually put into it. But if you have cash that you have, we'll call it, at least 2 to 3 year timeline where you don't know that you'll need it, I think that's a great solution. And they're not, they're very available. Well, I guess actually I shouldn't say this because I've been reading that the Treasury Direct website has been crashing from the number of people going there to purchase I-bonds. But in general, they can be purchased directly through the Treasury online.
Mm-hmm. I think they're limited to what, $10,000 a person?
Yep.
Yep.
Per year.
Yeah.
Yep. Close to the end of the year. So if you have a fair amount of excess cash, you could put some in this year, and then when the calendar turns, do it again.
Mm-hmm. All right. Perfect. Well, we have no more questions coming in. So we just want to say thank you to everybody for joining us today. Thank you for your continued support and confidence in Klaas Financial. We'll look forward to seeing you in your meetings and at our next quarterly webinar.
Take care,
Thanks so
everyone.
much.
Thanks.